Hey guys, it's Simon with Trading Perform Coaching, and wanted to change the focus of tonight a little bit away from what we did or didn't do in the room to a bit of a broader focus on what's going on with the broader market right now. There's an article that I posted um, on our stream, on my stream in StockTwits and Twitter, and it's basically talking about the head of Morgan Stanley's trading desk, and he was talking about the difficulty of trading, and he basically said um, that if you go through the article, that basically the consistent, he goes, it's choppier, it's gappy, and it's highly insured volume. I'm not exactly sure what the comment on the highly insured volume is, but the choppier and gappy makes a lot of sense, right? If you look at where trading desks excel and how it's been for the last 5 years, you'd almost want to say that they really have a difficult time when the market, or at least they've maybe forgotten how to trade when the market, in a post QE environment, right? If you go to a big chart, big time frame chart here, and look up at the top, you can see here that a couple of months ago, let me pull this in, right, when we come back all the way up here, right, and this is coming into October, September of last year, and look how controlled the trading is. Consistent up, not very wide ranges at all, right? Nice small tight ranges. And as far as trading desks, professional trading desks are concerned, they really like this kind of environment where it's very easy for them to gauge where the buy response is, where the sell response, and even if these days where you look where the range is relatively wide, right? It only lasts for a brief period of time where you're talking about an entire range from 2050 all the way down to just past 2030, right? So basically a 20, 25 point range on most days, and very controlled and mostly to the upside, right? They really like this. Their transactions are very easy to execute. They have very low risk in taking a bid and then offering it out on the ask and capturing the spread. And their traders pretty much have an easy time uh, regulating in this environment how they're going to put on risk and how much risk they can put on. But now look at what would happen all of a sudden over here. Look at our daily ranges. We're talking about, rotations, some days straight up, some days straight down, no regularity, no trend per se that's tight and easy to control, right? You can see here we're rotating from 1910 all the way down to past 1870. So you go from a range of dealing with 20 points worth of range to all of a sudden dealing with 40 and 50 points worth of range in both directions, right? And you can see the regularity and whether we drive up or down seems to flip on almost a daily basis. Look at just the last couple of days, right? Going back to the third, we open, drive straight down from essentially 1910 all the way down to 1870, right? The next day, we open up, we essentially drive from 1890 all the way to 1920. Next day, we open up, slight gap down, right? And we drive essentially in almost a straight line, at least on the larger picture, from, let's just call it 1905 all the way down to 1870, right? Literally the flavor flipping every day. We go to yesterday, we drove from essentially 1852 all the way down to 1825, and then today we opened up and drove straight up. So a couple of things. It's not like I trade that environment a whole lot better than JP Morgan does. But I do have to sidestep just like they do, right? When you don't have a regularity in how the market responds to a particular area, it makes it harder, right? And so let me think on where I'm trying to take my comments. So the first thing that you know is that large houses are having a hard time figuring out which direction the market's going to go. That means that they're going to reduce their bid and ask. That's why if you look at the dome during the trading day, the dome has gotten a lot thinner, whereas in the last couple of years, it got pretty normal to see 300-400 contracts per tick level. You're now seeing at times 5, 6, 10, 20 contracts, very, very small, and it makes for quicker, wider ranges, and it also requires a bit larger stop in your trading. I think that's the first area where I'm seeing a lot of people have difficulty. Secondly, This market forces you to know where your highest odds setups are and where to sidestep. So automatically right now, because of the way that the market's driving in both directions out of the gate, most days I have to sidestep the first half hour. If you look today, in the first 5 minutes of the day, right? If you look at the first 5 minutes of the day, look at this. This is just open and straight drive up. Now, if you could figure out that we were going to open up and straight drive up, kudos to you. But the question I would have, right, is if you could figure that that open was going to come up and straight drive up, how were you able to figure out that we were going to open here and straight drive down, right? There's really no rhyme or reason. And additionally, if you look, what we're doing is we're taking large swaths of territory when we push this to a 15-minute, and basically we are auctioning and re-auctioning, and you're basically having to find the edges here, right? If you look today, the edges, we were in balance, right? But it was balance over pretty much a 25-point range. It was a huge balance area, right? And so the first thing, some of the challenges are, in that first hour, we drove up, this was the high of the day. We couldn't push to a new high and we couldn't push to a new low. So for me, that's challenging because when I'm looking at a balanced day, what I'm looking for are pushes to the edges, right? Which means I'm looking for a push below the first hour high or below the first hour low for a trade back into the middle. That never develops all day long. It pretty much takes that trade away, right? The next thing, if you look, we finally did get this push out, right? But how do you know this push out in this particular circumstance, right? How do you know this push out isn't going to result in a very hard drive to the upside to close the open gap? And the answer is you don't. And if you look from a couple of days ago, I'll drag this over, right? We had a circumstance where people thought, oh, I've got the number on this market, we're in balance, and really if you look, here at the end of the day, it looked like we had open drive lower, consolidated in the middle. You would have thought, hey, we're just going to drive and come down to this 1850. Instead, we drove literally in the last hour and a half of the day from 1874 all the way up to 1910, right? So my question is, once we broke to the high, how would you possibly have known today? And I understand that some people just took the trade and maybe there was tick divergence and maybe it trapped back in. I'm sure that some people got this trade, but how could you know with a high degree of confidence that we were just going to stop in the middle of an unauctioned area? Prior, there was a gap right here that we filled from a couple weeks ago, but the bigger gap was up at 1874. And my point is behind this is all this is creating an enormous amount of uncertainty in trading, right? So that comes back to, well, how do I handle that enormity of uncertainty in trading in this environment and still excel, right? That's really the question that needs to be asked. And the way that I do that is in three specific areas. First of all, I don't short the last hour. So on days like yesterday here, saved me. On days like this day right here where we just drove super hard up, I'm not really looking for shorts in the afternoon. It saves me from getting run over in these particular situations. And while I understand that on paper they look tradable, believe me, in real time and when you're trading with leverage, this is a very violent move. And if you can pick the top in this, I give you a lot of credit, but my experience has been what happens with traders in this is they end up taking long or short stop, because most intraday traders are contra traders, right? So they'll take short stop, short stop, short stop. Then they'll try to catch this rollover and it ends up stopping them out again, right? Most people are looking for, are not looking for this kind of move at the end of the day, and it's really pretty shocking when you get it, right? Additionally, I'm pretty much sidestepping the first 30 to 45 minutes of the day, if not the entire first hour. Why? I don't want to get run over like I did this morning. And again, I don't want to guess whether it's going to be a trend day up like we had a couple of other, it wasn't too long ago, so I can find it pretty easily. We pretty much had, if y'all recall this day, right, we gapped, had open drive higher, and trend dayed up all day long, right? In this case, we pretty much gapped down, and we had trend day down all day long. Next day we had open drive gapped up, open drive lower, balanced, and then we pretty much V'd back up, right? We are getting so many different looks thrown at us. You have to narrow you have to know what you're looking at. So this is what I am looking at in the room and where we are getting profitable trades. We're looking for 20-point rotations minimum. We're looking for tick divergence intraday. We're sidestepping the first hour, right? And we're looking for a divergence into new lows between NQ and ES. Today, I can show you some of the areas where we took trades. And what I'm hoping to accomplish from this video is, first of all, for people to understand, hey, this is a pretty tough environment, right? How are you going to do this successfully? And then the other thing that we're really keen off of are 50-60 retraces for potential entries. And so I can show you here, if you look today, and this push up here, it's right here, you can see that we pushed right to the 62 retrace, just a little bit back behind it. And if you want to see what the zone looked like, I came in right into the zone, so I can pull that up. See if I have it here. So this is the trading chart for today, right? So first of all, you can see every zone. This is the exact reason why we skipped the first half hour, right? So when we're doing the zones, the idea behind the zones is that first move into the zone is, I normally would expect rejection and rotation down. Now, a couple of weeks ago in the first half hour, first touch of the zones was absolute gold. There's no other way to put it. That environment has shifted. And so being a professional trader, my job is to automatically shift with what the market's offering. So if you looked at my trade logs from a couple weeks ago, you would have seen in the first half hour, I was taking almost every touch of every single zone, whether it was in the first 5 minutes or in the right up until the last hour, right? So now I'm pretty much having to skip past first hour. But if you look after the first hour, right, notice that while this zone got blown out the first time through, first time into this 1835 to, or 1836 to 1834, we get a responsive buy back up, right? Notice that we push back up. The zone, this zone right here, at least held, right, prior to pushing, and then attempted to make a push all the way back up to Monday's high, right? So notice how the zones operate. We finally get to Monday's high, we reject. We do a 50-60 retrace, which is also aligning itself. So here's the 50-60 retrace. Right, so you'll notice first time into the 50 it pauses, not a very big response, right? Comes down past the 62, the closest zone to the 62 retrace is 36.34. Big rotation off of that 36.34, right? We come back up, the backside test of this zone holds for rotation back up, comes back down, we retest 36.34, it's already been tested here, right? It holds for 20 minutes, then it breaks, and then we just miss this 1829 to 1827 zone down here prior to seeing, and Globex low, right, which was already tested out of the gate. And again, what you would normally expect in balance is what would have happened is normally we would have expected to come in, tested Monday's low, trap back inside, and then pushed. We're just in a weird market, right? And then you can see the market behaved properly in the afternoon. We push out to new high, above Globex high, trap back in below Globex high, and push back down. You can see again the zones were quite effective even late in the afternoon. So at any rate, I guess my message here, particularly the guys in my room, is this is hard, right? This is about as hard as we get in trading, and that's why I've really slowed the roll down, and I'm taking much fewer trades. I'm really focusing on zones that line up with structure and 50-60 retraces, and I'm really trying to stack my evidence, meaning I'm really looking for tick divergence. I'm really looking for a 50-60 retrace, and I'm looking for structure to help me find responsive buy and sell areas, right? And then if you look at this last characteristic so you can see how much trouble I'm having, and I'm a scalper. Imagine a guy who's trying to move 5 or 10 or 20,000 contracts in an environment like this would really be pulling his hair out, right? One day open drive higher, the next day in the exact same area open drive lower, and we're auctioning these wide swaths. So the other thing that I wanted to point out is if you look at this big picture, right, while the ranges are huge and there's potentially, if you can get a hold of the right trade, right, we're not making a very good bull case, right? In order for the market to push up on the bull side, first thing that has to happen is we got to get above this level right here, right? We got to get up above this 1880 to 1900 to start moving up. And if you'll see, when we were working our way to the downside here, before we rolled over, we essentially formed this huge balance area, right? We made an attempt. If you look here, this is the area I'm talking about right here. We made a feeble attempt to break to the upside once, and then a second time, right? But we kept trapping back in underneath 1900, and notice we were ripping pretty much in this entire period from 1900 all the way down to 1880, 20-point essential poorly auctioned area over and over again, right? And if you look again, what are we doing right down here? We're essentially rebuilding that exact area. And look how long we stayed in this area too, right? So this is, if you start counting here, this is 1, 2, 3, 4, 5. After 5 days of consolidation, we had a move out of balance, right? And then we had 1 day of balance, moved back into the consolidation range, right? We had 1, 2, 3, 4 days of essential balance back into the same area with attempt to push back up. That finally failed on this particular day. We attempted to hold above 1900, and we drove all the way through the range, and we finally gapped down. So now we're on day 1 and day 2. We have Fed speakers tomorrow. So we know a couple of things. First of all, notice the market has had a very, very difficult time sustaining over this 1851, right? We weren't able to even really close the gap from Friday, right? So the first thing that we want to see is, the first thing you need to know for a bull case is, can we get above 1875, right? That closes the gap, and can we hold? And then when we push back down for a downside test, do we hold above 1851? You can see quite clearly the market's having a very hard time holding above and closing above 1851. If we can't hold above and close above 1851, this is just consolidating at a lower low in a balance area, and will bring us down for a retest of this 1804 eventually, and then destinations lower from there. So the nice thing about this is you have a pretty good argument here, or a pretty nice understanding of what you need to see in order for the bull case to resume. And I don't know if bull case is a little bit strong, but at least to come back up and test these upper areas, meaning 1900 up to 1940, right? So the first thing that has to happen, we have to get above and hold above 1875, whether that's a gap, accomplished through a gap, or we trade through it intraday, right? Secondly, even if we come back up here, we're highly likely to see rejection at 1875, but on the test back down, can we hold and close above 1850? If we can, even if we come up and reject off of 1874, the first constructive sign would be that we hold above 1850. That would open the door after this gap is closed to come back through and swing back up. And guess what? Above this 1875, we're poorly auctioned again. Guess where? All the way back to 1900, right? And then you want to see that resiliency hold. This time on the test back down, you want to see 1874 hold. Then we can push through 1900 and re-auction back to 1920 and 1940. And that would actually be a pretty nice move from where we're trading right now. The other important thing to remember is back in 2011, when these rallies can be pretty face ripping, right? I believe the rally, we had a 211 point rally in 2 days. So it's worth keeping a check on, at least for me, where's 200 points away to the upside in case we do get that face ripper, so I'm not like, this is unbelievable or it can't happen. So from our current swing low of 1824, if we were to tack on 200 points in 2 days, that would put us from 1820 all the way up to 2020. And if you look on a bigger time frame, that is very doable. Let's look at this really quick. 200 points from where we are right now, 2 days, would shockingly put us right in the middle of that unauctioned area up there at 2020. Do I think it'll happen? Well, not right now. I need to see something instructive, starting with holding above 1851 and then holding above 1875. But I do look, if we can get above this level right here, this 1941, this whole thing from 1941 to 2012 is really poorly auctioned, and we can rip through this neighborhood pretty easily. So I wanted to give a bigger picture look, give some people some ideas of how I'm handling and how I'm approaching the market. And right now, the key for me is sidestepping the first 30 minutes, sidestepping the last hour, and then having multiple signs that I have a good trade. Primarily focus on the 50-60 in combination with structure and potentially tick divergence at the same time, or for those of you who understand what I'm talking about, looking for pools of liquidity to grab scalps off of. And I am scaling at 2, 4, and 6 point scales right now, and then trying to get stretches off of that for 10 to 20 points on my trailers. But that's how I'm approaching the market right now. Everyone's struggling, and so remember, the key here is, even if you're small profitable, make sure the trade you're taking has very high odds and it's a very good structure for entering the trade. Guessing can be very, very expensive in this environment. Anyways, I hope that helped, Coach Simon, and remember to keep your mental game sharp. Take your time. You don't have to make your money today. This difficulty of having a wide, choppy range will go away and it'll get easy again, but not if you don't have any capital to trade it. So anyways, I hope this helped out. Have a great night. I welcome your feedback on both Twitter, StockTwits, and on YouTube. So have a good night, guys.